Today's episode of Crowd Forecast News, a solo market outlook episode with the option professor. He discussed his outlook for the S&P 500 and his thoughts on what the Fed might do about inflation over the next few months. He also talked about the QQQ, IWM, DVN, HAL, MRO, WMB, and more. And now here's the episode. Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News for August 29th, 2022. We are recording this at 1 p.m. Eastern Time, and this is episode number 357. Today, the option professor is here to do a market outlook episode, so I'm going to go ahead and turn it over to him.
Okay, thanks everybody for being here today. We're going to go over a lot of different information. We're going to cover how we saw the turn in the market, which was very, very accurate, and we'll explain how we did that. And also, we are going to go over the different things that you might be doing out there in the market, such as the stock market, meaning S&P, plus the Qs, plus the SMH, plus the Russell and the small caps. We're going to cover all that, see what they look like, and give you our views and our opinions. And then, of course, we're going to go over other stuff that's going on as well. Now, before we get started, Option Professor is going to give you information today. It's going to be the opinions and our observations. What we are not giving out here is anybody advice. When you need advice, you go to your brokerage firm and your broker, and you discuss your suitability and your risk tolerance and what's appropriate for you and what's not. Since we don't know you personally, obviously, we can't give out advice like that. But we will give our opinions and our views, and hopefully some of that will be helpful to you. Okay, without further ado, let's get started here and talk about the S&P 500 index. Okay, the S&P today has been, I'm trying to get a, I'm going to try to get a refresh on this thing here and see if it will start updating me a bit. Let's see if it'll do that for me. Okay, well these some of these are prices from Friday. But I will, obviously we opened much lower today and then we bounced back. But as of Friday, this is what some of these numbers will represent. Well, maybe I'll put the SPY up there and that might give me a current update on the prices here. So let's go with that and see what that looks like. Okay. Okay, that's a more updated price on things. So let's start out with SPY. We'll use SPY instead of SPX today. It's just so we have up to current prices. Okay. All right. So there you go on the SPY. Again, why did we think there could be a turn? Real simple, because we ran into the moving average that we use on the 20-year, which is right there at what? 431.34. What was the high when it went up there? Let's see. The high was 431.73. Hey, that's pretty much right on the number, isn't it? Okay, now you throw in there a Fibonacci retracement where we went from 4,800 ballpark on the S&P down to 3,600 ballpark. A throwback takes you to right around the 4,350 neighborhood. That's where we hit. That's where we thought it might go down from because of the Fibonacci number. We also thought it would go down because of it hitting the 12 SMA on our long-term chart. We also thought it would go down because the VIX hit 19. And the last three times the VIX hit 19, we got a 400-point drop in the S&P. And the VIX went way up above 30 or near 30 just about on all of those times. Today, the VIX hit 2767. Okay. So VIX was at 19. That told you a turn. Then you had the Fed meeting. What did you think he was going to say at the meeting? That we're going to ease money and credit when inflation is still reporting 8 or 9%, when we still have the jobs rate at 3.5%, when we still had online retail sales up 2.8%. I mean, he's supposed to be slowing things down. Wouldn't you say so far it's been an abject failure? Of course it has been, because just look at the numbers. Okay, so obviously, what's he going to say at the Jackson Hole? We're going to ease money and credit so we can get housing prices up to 1.5 million for a condo in the middle of the country. I don't think so. So again, if you add up the preponderance of the evidence, hitting the red line there, the VIX at 19, and historically in, I think it was in April, and then of course it was in June, and now we're here in September. Seems like quarterly, right? Looks like quarterly, the VIX goes down to 19 and then it explodes to the upside. So a lot of evidence to, and then we talked about people to hedge. So Our compass said it's rolling over. And obviously that compass was extremely accurate in the last week, because these reports that I'm talking about, these called quick alerts that we send out, one went out on the 23rd, which explained another thing, which is the first time we approached the 200-day moving average, it fails historically. So that's an awful lot of evidence saying hedge, get out, trim, whatever you do to protect yourself. Okay. Now we have a PDF report called How to Hedge Against Market Decline and Upside Surprises. And we think it's very, very helpful to most people. So at the end of the broadcast, I'm going to explain how you can get that as well. Again, we've been doing this for decades, many, many decades. So again, we saw a lot of stuff in history, this stuff where rates have to go up because inflation is going nuts. We already saw that move in the early 80s with Volcker. Now, again, the Fed knows very well if you play games like you did in the 70s, where you hike rates and you ease, and then you hike rates and you ease, and you think inflation's under control and it's not, that's what leads to the Volcker. We have to go to 15% to get it under control. Okay. Now, the bond market is a huge bubble. Interest rates went to 0.5% on treasuries back in 2020. And we told people that, that is a bubble that is going to burst. And it is starting to burst as far as treasuries are concerned, because now we're at 340 something on the 2-year note, and we're well above 3 on the 10-year and the 20 and the 30-year as well. Again, there is a consensus out there, and it may have some merit, but I'm not going to worry about it until we see some evidence. But there is some people who think that we're going to get 75 points in September. They're going to skip in November because of the election, and then they'll bang it one more time at the end of the year. And then they're going to sit tight and see what happens. So if we go 75, they'll be at about 3%, 3.25% after this meeting. And then if they go another 50 in December or 75, they'll be pushing that 3.50 to 4% area. Okay. And then, of course, they may hold off in the beginning parts of 2023 to see if the economy is going to start giving them what they want, which is what? They want to see housing prices drop. They want to see unemployment rise. They want to see spending slow down, okay? Because you can't nobody's going to bring prices down on anything unless they have to. And they have to when demand gets soft. And right now, the bars and the restaurants are full. The casinos are full. The airlines are full, right? And you're seeing, people spending money all over the place. And that's not the way you get inflation to come down. Okay. And the housing, yes, of course, we've seen housing contracts slow down. Well, don't forget, you had a tremendous amount of buying. There's not unlimited buyers in real estate. So again, the spec buyers definitely left the party, and the new buyer is trying to bide his time to see if he's going to get a better price. So of course, contracts are going to be way down, but I haven't seen the prices breaking dramatically yet. And the prices need to break dramatically for inflation to come down. Okay, so it is a situation that we could see a route towards 75, take a skip, and then hike again in December, and then wait. It's possible. But, again, we've got CPI coming out, and we've got a jobs report coming out, and we'll have to see how they look. But I mean, the easy wood to chop is probably going from 9% to 6% or 7%. The tougher wood is to get it underneath that. And again, without those items that I mentioned. So now the big risk to the stock market is not really the Fed right now. The big risk is, what are these earnings going to do? Because again, with rates going up, again, there's two things that you look at. One is called the price, and then the earnings and the valuation, right? So we went from this year, the S&P started the year at around 22 PE, and it dropped to about 15 in June. The NASDAQ started the year at 32 and dropped down to 21 in June. That's why the snapback rally in the NASDAQ and the growth was much greater than on the what? Than on the big caps and the S&P type stocks, because the drop in June was much greater. So the bounce back, of course, was greater as well. So we just recently went back towards 27 PE on the NASDAQ and about 19 on the S&P. And that's too high in a rising interest rate environment. Now, if people tell me they're going to go to 3 or 3.25 and then stop there, then the valuations can come back up. But if they're going to try to get to 4%, like Bullard says, again, our opinion is that these valuations are going to tighten up again. Now, that's door number one, tightening of valuations. That's also what's causing the sell-off here in the last week. Because again, valuations got rich. They went back up tremendously during that rally that we saw in June, July, and into half of August. Okay, now what's the second part is the key, earnings. In some sectors, the analysts are starting to reduce their earnings estimates, not only for Q3, which we're just ending in about 4 weeks, but also in Q4 and 2023. Okay, but they're not cutting them in some sectors like energy, because energy companies are making hand over fist. And again, as long as energy is 80, 85, 90 bucks a barrel, and as long as they're squeezing that energy people over there in Europe, and the natural gas is very strong, companies like LNG, et cetera, they're going to make money. Okay. And companies like Chevron and Exxon and all these guys, they're going to make money. Okay. So when they make money, and their PE ratios are not outrageous to begin with. So again, that crowd is the light they are the shining one-eyed man in the valley of the blind. Okay. So what about all the other sectors? What about consumer discretionary? What about things such as tech and semiconductors? We'll look at them in a second, but those could be more vulnerable to either valuation compression or cuts in their earnings estimates. Hey, listen, Apple's having a big deal on September 7th. They lay an egg on September 7th. Apple's going to get nailed and it's going to break 160. And if it breaks 160, it's going to go back into the soup. Okay. That move up to 178, that seemed to be a very aggressive up move for Apple, unless they've got some products that people just cannot live with, even after they bought how many of these iPhones, 13, 12, 11, is 14 a real game changer? We'll have to see. The other thing is gaming parts of the economy are getting weaker, meaning the gaming chips out of NVIDIA, other gaming stocks have not been doing as well. I don't know why that is. Maybe these people who do the gaming, I'm not a big gamer, but maybe they've had enough. Maybe they have enough games. Maybe they're not willing to pay as much for new games, whatever. Or maybe they're actually getting out of the house and doing things and not gaming as much. Okay. But there seems to be a little bit of a softening in that sector as well. So again, we'll look at some things right now. But again, the viewpoint here is that if we get through the 200-day moving average, which is around 43.25, 43.25, 43.50, again, that would open the door for the 45, the 46, the 48, the 5,000 that people are hoping for that are extremely bullish. That would open the door, but that door remains closed until you get through that 200-day average. And how will you get through that? Clearly, earnings do not back off. And in fact, they surprise on the upside. That would be something. And how could that happen? This interest rate, tiny, come on, historically, 2.5%, 3%, that's still a low rate. They just were a joke for a while. Imagine refinancing your home and getting a 2.5% 30-year mortgage. That's a joke. Jokes don't last. And that's why we're already at 5.5%. Okay. That's another thing that could make it hard for real estate to come down, because, who's going to sell their house if it's a little bit lower than where you bought it, and you have a loan that you could certainly afford because your balance sheet in households are about as good as they've ever been. And same thing with banks, their portfolio, their cash situation. So, it's hard to get people to just give up pricing if A, demand is there, or B, there's no alternative to getting out. So again, this is some of the problems that the Fed is running into. So again, how is this the rest of the year going to work? It's going to work on how earnings do. And if these earnings do come off and the rates go higher, that's the double whammy. And we probably revisit the lows, if not take them out. If they can come in good and we are surprised and the rates don't go as far as you think, because maybe he gets a CPI print that says it's okay, and maybe with the election, he doesn't want to see any problems, then you could get a rally. Because if the Fed takes a pause for whatever reason, that's going to be bullish to these people because it's going to relieve the pressure on the valuation number. And it probably will get the public keep spending. And if they keep spending, the companies can make money. Okay, they can make money. So again, it's not a slam dunk we're going down, but the momentum has turned to the downside, at least on the short run. You can see from my long-term chart here that we love this long-term average we use because every time you bought it anywhere nearby, you were getting the deal of the time frame. In other words, when was the best time to buy the SPY? Certainly around 2011, 2012. How about a reload? How about we reload in 2016 when we have that little scare, right? How about if we reload in 2018 when they do their first hiking? How about if we reload right as soon as the Fed comes in and saves us from COVID and it gets back above it? How about if we just bought it in June? Do you understand why we follow this? Because that's the great time to buy. You know, it's a lousy time to buy 4,800 when it's going to revert back to the mean. When it's going to revert back to the mean, you're going to get wiped out. How about if you buy it up here right before the COVID is announced and it's going to revert back to the mean and you're going to get wiped out? Do you understand why you don't want to buy these things? And that's why it's very important to know where you are as far as time is concerned. But if you have a nice relative strength index above 50 the whole time, that's another reason why buying the dip makes a lot of sense. That's why buying the dip again in June made a lot of sense, and July. Okay. But now we've got to see, maybe we're going to go into a trading range of about 380 and 430 on this thing. And then we'll find out how the thing shakes out. So just like the Fed is going to raise and wait, maybe what the market has done is raised it back up and it's going to wait. And wait could be choppy action as companies announce bad stuff like Nordstrom and other companies like Applied Materials, AMAT, says things are going to be okay. And as these reports are conflicting, so are the prices in the market. Okay, so that's a possibility as well. All we do know is when we're at 43.50, we thought it was a great time to hedge, a great time to short, and a great time to do anything that has to do with getting on the other side of the market. And so far, that's been correct. Again, right now, getting back above 411 on the S&P would be constructive. Right now, it's at 403 and change. So again, the green line coming in at 411 would be something of a construction if it can get above that number. If not, again, you see where the blue line is, and maybe we will go down and test that in the month of September. Remember, every time this year we saw the VIX under 20, the S&P within a month had a significant drop. And so we got the VIX under 20 in August. So that would mean September could be a rough month if history repeats itself, but it's certainly worth looking at. And again, what do you have going on in September? You got a big hike coming up. You got some numbers. If the numbers aren't very good, they're going to become more hawkish with their statements. Again, they're trying to get people to stop spending so much money and people to stop raising prices so high. And again, I see no evidence of that when I go out. I see no evidence to speak of, you know, that looks dramatic. All right, let's look at it on a 5-year basis. 5-year basis, again, you see how it went up towards a blue line. It does a peek through, right? And now it's back underneath it. So getting above 420 would be very good. You see the red line coming in here at what? 399. That's why it's holding right now. It's bouncing off of the red line, right? It breaks that red line, you're going back in the soup. RSI is under 50 at 47. Look at the RSI in the 5-year. Okay. So if this thing breaks, it's going to be a problem. If you wanted to trade it, obviously you could trade it against that 399 mark. And so far that's worked because today's low is 401. Okay. So that's a number to work with there. Looking at the 1 year, again, it comes down, it comes back up, right? Can't get above the red line, which is right at 420, takes out 410, and you get a pretty good move on the downside. The blue line is still rising. So again, getting above, what did I say, 411, getting above 406 and a half, getting above 415. These would all be positive things if they can do it. But the relative strength is down at 43. So it's under sea level being 50. Okay, and then you look at the 1 month. And the 1 month, again, doesn't look very good either. You got resistance 412, 416. And then 412, you can see these numbers might be resistance too. So again, the market doesn't go in a straight line, right? It did the last 3 days, but that's not the norm. It goes back and forth using obviously some of these resistance and support levels as a guide. All right, let's go over. And so I gave you a little overview on what we're seeing here on the S&P and support and resistance. Let's put up the Qs and see what that looks like. Most of you own stocks that are kind of in these type of genres, right? S&P's kind of stocks, right? And then you've got your NASDAQ type stocks, okay? So there you go. Again, this thing couldn't even get up to the red line, which would have been to 350. It did get up to the green. The green was 333. What's the high been for August? 334. So, you think it's a coincidence it backs off these numbers? I don't think it's coincidence. And then your blue line is rising and it's coming in at what? At 296. So far today, we have held that so far. 276 is the monthly. Well, let me put it on this one here. Yeah, the low is 306. Excuse me, 303. And this low here is 296. So there's some support down there at 296. But again, when the red line is pointing straight down like that, that's generally not the best way for it to be pointing. Do you notice when it's pointing up is where you make the money? Pointing down like that, not so much. Looking at the 5-year, again, ran into the blue. The blue comes in at 326. So now it is holding. Again, if you're a trader, you could trade against some of this stuff. Where's your red line here? 303.76. What's the low today? I think it was 303 and change, wasn't it? Yeah, 303 and change. And look where the SMA is, 303. So there's a reason why it's bouncing off of here. And again, the red line here is pointing up a little bit. So it's possible, again, you could get a bit of a bounce, but certainly underneath 303, that would not be a good thing. So I'd be very careful there. RSI is under 50. So you're inherently a little bit weak here. Okay, going into a holiday, which we are this week, right? Sometimes you get the market to rally. People like to cover their shorts, go out to Long Island, have a nice barbecue, right? Or maybe people who are in there already say, forget about it. I'll look at it when I come back from holiday. Okay, so sometimes going into a holiday like Memorial Day, you got a very nice big rally. July 4th, I don't think it's so much. Let's just see what it did in July 4th. Hold on. July 4th holiday. Well, yeah, it started to rally coming into right after July 4th. Yeah, right after July 4th, it rallied. So sometimes you get a nice bounce. You got one here into Memorial Day, and then you got maybe one coming here going into Labor Day. So if we hold 303, could it have a little bit of a pop? Yeah, it could have a little bit of a pop. Okay, on a 1 year. Again, it's trying to get back above the blue line coming in at 311. Where are we trading now? Okay, so it's got to get above 311 to show anything. Red line's pointing down, RSI's thing. So could we pop up towards 320 because of the holiday? It's possible. And then could it have trouble around there? It could. Bottom line is it's on the defensive right now because, again, this theory that rates are going to get cut anytime real soon, that's out the window. And the Fed doesn't have the guts to do aggressive hiking. That sounded like it's out of the window. I think the Fed finally got religion and figured what? This inflation is not a joke. The amount of money we printed was an absolute moronic thing to do. They brought the balance sheet to $9 trillion. Now QT starts next month. They're trying to bring a $9 trillion gorilla back to 4 or 5 trillion. That's no easy task. If that's a draining of liquidity, that's going to make the markets more volatile, not less. Because you see, when the Fed's not buying mortgages and treasuries, that means dealers have to do it. And one thing about dealers, if the market comes in with huge volume on one side or the other, they don't want to throw their checkbook in front of a nightmare. So that's why the markets can get a little bit more volatile when the Fed's not in there doing the buying and selling. And according to what they're supposed to be doing, they're supposed to be reducing the balance sheet. We'll have to see if they actually do that. But if they do that, that's a big buyer coming out of the market. So that increases volatility in the debt markets and others as well. In other words, we used to have that Fed put. If the market drops a little bit, the Fed will come in and save us. That Fed put seems to have gone on a long-term vacation right now. Okay, so there you go with the Qs right now. And then we're going to go over to the 1 month and see if there's a little bit of a turn there. But really all you're doing is it's a bouncing ball that got thrown off the Empire State Building. And of course, it's going to bounce when it hits some kind of a floor. It is hitting a floor around 303. So that's why it's having a little bit of a bounce. But it's certainly lots of clouds above, lots of clouds above. All right, let's take a look at another area where you guys might be investing, which is the semiconductors. Okay, looking at the semis. Again, red line pointing straight down. This is another one. You know, Qs and the semis could not even get to the red line. At least the S&P did. Here you're 260. You never got that far. The highest you got was 247. Okay, 247 coincided with the 24 SMA, and that was 244. So 247, 244. Obviously, another area that would have been resistance, and you either you hedge yourself, or you fade it, or you trim, or whatever you do to defend, right? Okay, or you can replace it. All right, so there you go there with the SMH. And again, still a rising blue line. So that's why, again, there is some merit that if the Fed does, and the Fed seems to be pretty unpredictable when you really think about it. A year ago in Jackson Hole, they were screaming transitory. So how wrong was that forecast? Now they're saying high and keep them high. Well, that's their forecast. With the history of their forecast from last year, how much credence can you put into it? So the bottom line is what? Things could be a lot different than what they said. It could be a deal where, again, they hike in September, they pause, they do a tiny hike in December, and then they leave it alone there. And if that's the case, the market's going to be bullish on that. Because believe me, in this world, a 3.5% Fed funds rate is not scaring anybody. From what? From spending all that money they've got in reserves? From spending all the wealth that was created with the asset bubbles that have been created? That's not going to send people running 3.5%. I don't think. It might take some froth off, but froth off is a lot different than a significant correction. And unemployment is not going to go way up with a 3.5% Fed funds rate. No way. In my opinion, in my view, right? So, but if they play it that way, then we're back to the 70s where, oh, we stopped and we thought it was over. Boom, it's back. Stopped, back. And the next thing you know, the hikes are not going to look like 3.5. They could look like 4.5, 5.5, or 6.5, which the entire planet is not ready for. Okay. But if we had what some people say, a grand super cycle top in the bond market back in 2020, there's a lot more selling to be done. If we had a grand super cycle top in the stock market when the valuation went to 23 and we were at 4,800 and we were at that high price on all those meme stocks and all these stocks trading without any earnings, if that was a grand super cycle high, there's a lot more selling to be done. Okay, if that's the case. Okay, so and you have to respect that. So again, if you on the semis, if you start taking out 200, we're in a different ball game, right? We're in a different ball game. Right now, we're having a correction, and the trend still seems like it's up as long as it can stay above what, 209. And again, getting back above 244 and 260 would be very helpful. Right now, we're at 208. Okay. Again, the guys who are thinking we're going back to 5,000 on the S&P, they may be looking at the long-term trends. Again, the long-term trend on this thing is still okay as long as you stay above 200 or so, 210. The long-term trend on the Qs is okay as long as you can keep this thing above 296, 297. Okay, on the SPYs, as long as you keep the SPYs above 377. 377. Again, those three markets still have that blue line rising. And so that's why there's no way I'm dismissing the concept that we could go through the roof, because this Federal Reserve is a very, very bad forecaster, and they changed their tune. I mean, transitory and it's going to go away a year ago. That's only 12 months ago, right? And they were wrong within the first 6 months of that thing, right? Because by January, they knew that was wrong, or by November, they knew it was wrong, right? Because they started hiking in November, right? So the bottom line is that, they could be wrong. And this economy may give them what they want, which is what? A little bit of unemployment pop and the prices. Don't forget, inflation is the rate of change. It doesn't necessarily mean prices have to come down that much. Okay. So if the prices don't come down that much, but the rate of change does, companies can still make a lot of money. And that's why you got to respect it. So if we get above 43.25, 43.50, and you start seeing prints above there, the game is on for that rally that everyone who's bullish is waiting for. Because again, the earnings probably won't back off. And that's the whole thing. But right now, it looks like the earnings will back off. And right now, it looks like the Fed will do what they're talking about. And so that's what it looks like right now. But in this business, you've got to remain flexible. If you want to be like a big crystal ball guy, you're going to eat ground glass. You got to go with where the trends are. That's why we use the moving averages and the relative strength. We don't look at 90,000 things to confuse us. Okay, so we looked at the semis, we looked at the Qs, and now let's look at the small caps. This is the Russell 2000. Okay, this is another one hanging on for dear life, because the blue line comes in right now at what? 184 and change. Where is the low today? 184 and change. Where's it at now? 188. You understand why it held there? You understand why you played the bounce if you want to buy it there? You see the RSI is at 48. So if this thing starts trading underneath 180, again, that's going to be very, very not good for the markets. Now, a lot of people think that the small caps have already done their discounting. That's another thing. This is a market of stock. It's not a stock market. There are some companies that have already been discounted tremendously, that have already said they're going to cut their earnings, and their prices may already reflect all the bad news. It's possible you can find those. Here, again, we went back to the highs of 2018 and 2020. So you understand that correction has already been made. So if this thing can hold here and we start taking out 200, the small caps may be the best thing on the board. Because if there is a recovery from this stuff, a lot of people think sometimes small caps do kick in first. And they also think that obviously this is already corrected back down. For the S&P to come down to that level, you'd have to go to 3,400 on the S&P. For the Qs, you have to go down, even lower. So these guys may have done all the discounting and they may hold up better during a further drop, because again, they've already discounted all the way back down to the former highs of 2018 and 2020. And if that's where the Qs have to go before it's over, then there's a lot more to go. Because the Qs would have to come down to, it looks like 260, 240. And we already know S&P, I told you, would have to go down towards 3,400. Okay, let's go back to IWM again. One way I sometimes look at these things is, if I want to find out, I take the top 10 holdings of the IWM and I use them as a gauge. I take the top 10 holdings of the Qs, that's my gauge. I take the top 10 holdings of the S&P, that's my gauge. So it's, you can play stock picker sometimes just off of the top 10 in the index. With regards to the Russell, let's see what it looks like on a 5-year. You don't like to see that red line pointing straight down, though. That's generally not a good thing. Now here, the red line has turned up a little bit, and it comes in at 182. So 182, we just gave you another number. 182, 183, 180. That's a number of support. And if it's going to hold that, then you'll be okay. But the blue line is the dominant one, and the dominant one still looks like it's pointing down, and the dominant one here comes in at 192. So, as long as it's under 192, you still have to a little bit of worry, and your RSI is under 48. So keep an eye on it. If it gets above that level and takes out 200, that would be very positive. That'd be very positive. And it might tell you, again, that the Fed is not going to crush the economy. But if they want inflation to come down, what's the history of inflation coming way down without a recession? I don't think it's a very good one. All right, here you got a cap at 195. You can see that as clear as a bell. So what do we got? We said 192, 195. There's your resistance zones and your support. That's why, again, going into a trading range might not be out of the question. 195 on this thing and 187. Maybe it sticks in there for a little while as we see what's going to happen. It's nice to see the blue line rising, though. But again, it was rising over here for a while, too. And the key is this red line. As long as we're under 195, every day we are, that's going to make this red line go lower and lower and lower. And so if the red line keeps going lower, 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 and then you blow out the 185, then this thing's going to go into the soup. But again, remaining flexible. If the numbers go the other way, you got to go with the flow. But, and again, there are certain times that are better than others to look at these things. Again, as we hit 200, that was your time for doing your defensive activities. Okay. When it broke through here, get a little bit of a pop. Okay. So there you go with the small caps. So you had good range of things to look at. Now, what I'm going to do is I'm going to go over some of the things that we've been focusing on that we think have been looking pretty good. Now, some of them have already run, so sorry about that, but we'll show you some of the things that we've been looking at here. If you're looking at energy, okay, there have been some pretty good ones. We know DVN. We'll show you why that was a pretty great opportunity. But again, you have to be watching things, and you have to see where they go. So check this out. Devon Energy's up at 80. Everyone's bullish. Everyone's in there. All the newsletters, buy, buy, buy. You know what we're saying? We're saying stay away. Do you know why? Because this is called reversion to the mean. Reversion to the mean. And you went from 80 down to 50. Now, you know what you want to do at 50? If you want to take a chance, you buy. Why? Because it's right against the red line, right? And then it pops. And you had a couple of chances against the red line to buy it. And now it's up at 74. Is this a great time to buy it? Not as good as down here, right? And that's why we look at things like that. Okay, how about looking at Halliburton? These exploratory and production people, they're going to probably be pretty popular because, it seems like we need more of this stuff, right? So here you go there. Come on, get off of there. Okay, again, you don't want to be buying it at 45 when the averages are down here because it's going to revert to the mean and you're going to lose a lot of money. But how about when it comes back down here and gets back above the red line? So right now, we like this thing, but if it got under 30, we wouldn't like it so much. Again, the trend looks like it wants to turn. The RSI is nice and turning up, and so we like it. But again, this is more of a time to take a look at this one than the other. Schlumberger, drill bits. Okay, again, just going through the red line, so $35. Obviously, on Friday it was down, lower, so that would have been the time to take a shot. And then, your get out point looks like 35, 36.50 right now. Okay, and if it takes out 50, you're off to the races. And then MRO, Marathon. Again, just came down here to 20. You had an opportunity to do it in the last couple of weeks. And it was down around 21.65. And, that's where the low is on the red. And then you're up at 27. So it's already on the bicycle. Williams. Let's get some gas going here. This one's, again, hugging the red. So, we're constructive on it, but we want this thing to stay above 31. RRC. constructive on this thing, but we liked it a lot better at 25 on the pullback when it happened in June and July. But it certainly, looks like it's got a lot of potential here. And this is in natural gas type situation as well. Okay, and then other things would be Suncor up there in Old Canada. They got Elliott Management involved with them. Those guys seem to know what they're doing. So again, this thing went down to 30. That was the place to take a shot. It even went near 30 in the last few days, and now it's at 35. So it looks like it might be able to go someplace if it, gets on the bicycle. That's another one to keep an eye on. That looks pretty good. Then we've got CV. Hold on a second here. No. Well, we got one over there in Brazil, Petrobras. Now this thing looks like it really could get going someplace here if it really got moving, right? So you're down here, as long as it stays above 1275, it looks like it's something to keep an eye on here. And like I say, there's a lot of white up here, So if something happens, it looks like a lot of white up there. And so that's something we're keeping a look at as well. So the energy ones obviously are one of the better ones. The other one is fertilizer. We like the Mosaic. Mosaic is down a little bit today, but it's been good to us because, again, once it got above 50, that's where we got interested. It's at 60. And of course, if there's a problem with the food and agriculture and fertilizer, who's to say? But we don't like it at 80 when the moving averages are at 50. Do you understand that? So that's why we're not fooling around with it here. That's called reversion to the mean. And even if it went from 80 to 110, we would say, sayonara, have a good day. But we're not getting involved in things up at 160 here when the moving average is at 90 and 150, because we don't want to get in there at 160 and lose $100 a share. That's not our idea of a good time. So sometimes you are just missing the boat and you have to look for another boat where the setup is a little bit more reasonable from a risk reward standpoint. Okay, so there you go. You got a little fertilizer thing going. You got that going. There's a company that's going to be that we're kind of keeping an eye on in the shipping area. It's called Starbulk. And this thing, we really like to keep this thing. We'd love to see it above 25, and then we'd become much more excited on it. But it does look like it is in an uptrend, and the RSI is right around 50. So this is one we're keeping an eye on, not exactly slamming the table on as far as something that looks good right away. Here's one that we have been keen on, and it looks pretty good. It's a uranium deal called Cameco. And you can see there, it's been hugging the red line. So every time it gets near the red, it's been a good time to buy. And now it's popping a little bit here, and that may have a future to it as well. Again, this is uranium, and people are getting into that pretty heavily. So there's a couple there that look pretty good. There's a chemical specialty chemical company out of with Israel called ICL. And we are looking at that as well. Let's get this guy out of here. And so it's back above the red line. So as long as it stays above the red line, we like that. And if it started taking out 13, it could get popping pretty good. So we're keeping an eye on this one too. RSI is turning up. So it might be interesting to take a look at this guy as well. So that gives you a little bit of an idea. And here are some of the other ones that are trading above their long-term averages that look like they at least look solid as far as the technicals are concerned. Here we have, these are the financials. So this is your Goldman Sachs, your JP Morgan, your Bank of America's. As long as we can stay above 3165, you could still maybe make a case for financials, because, banks do have good balance sheets. And you know what? If the rates go up, you go to the bank, all that free credit balance that people have, these people who don't buy CDs and T-bills with the money, all that money is allowed for them to make income on. So, with rates higher now, 3% on short-term paper, the banks should be making a killing. And they're trying to loan money like mad to people. So, basically that might be telling us that they think rates will be lower down in the future as well, because their interest in loaning money is very, very, very high. So if the financials have a big future, there's a couple of numbers to keep an eye on there. Ones that have been doing well, and we've been talking to people about, as far as, if you want to hide out, this has been a place where people have been hiding out. This is the utility sector. I mean, that thing just has not broken at all. You had a nice big drop in June, like everything, but that was a great time to buy. And again, it pays good income. So this has been one that's been pretty steady. And this is obviously where people are hiding out, the utility sector. Now, whether it's going to keep going or not, at least you've got a trend to follow. And again, it's a little bit extended right now. So obviously this is not the great time to just start getting in. But if it comes down and hits the congestion point, it might not be bad. The other one is Staples. And the staples again are, this is your Procter and Gamble and, things that people need to buy no matter what the economy is doing. You can see they've been pretty solid as well. So these are the ones we've been telling you. You want to hide out someplace, you hide in there. You don't hide out in ARK funds and hope for a rebound. That's not a place to hide out. That's a place where you got a big relief rally and you should have used it to unload it probably, right? This company here is interesting because I understand it owns about half of T-Mobile. And it is Deutsche Telekom. And let's see here, DTEGY. So we found this a little bit interesting. On a 20-year basis, it's holding 18 so far. And again, if they have half of ownership of T-Mobile and they've got the European market, it might be a decent value to take a look at. Something to watch, that's for sure. And then basically one area that I haven't talked about is the metals, okay, industrial metals. Because what did China just do? They just announced 146 billion that they may be putting into infrastructure. Infrastructure needs metals and things like that. So this is where we love this thing at 10. We hated it at 55. We love it at 25. Okay. And now it's trying to get back on the bicycle. So if this is just a pullback and China's going to need a lot of materials again, this could have some potential. The other one that could have some potential that's starting to perk up is U.S. Steel, because we may have our own infrastructure coming, right? And so you can see U.S. Steel's looking like it might have a future. One over in Europe, but they are paying a dividend soon. So you got to watch that they're not going to get a big cut in their price because they pay a dividend. But this one is popular for the metals as well. These are industrial metals. And this is, again, it needs to get above 14 bucks. If it gets above 14 and 16, though, it could have quite a big future to it. Keep an eye on that, not right this second. And the other one is Cleveland Cliffs. And Cleveland Cliffs, again, looking pretty good. If it can get above 21, it looks like it could get going pretty good as well. So there's some industrial metals for you to look at, which would be infrastructure possibly oriented, and maybe the demand for that might pick up, and there could be a future there as well. Now, many of you or some of you are into the precious metals, so I'm going to cover them now. One that was very good for us, but another classic case is when they get away from the averages, we want no part of it. And so this is Newman Mining. I'll show you exactly where we got keen on it, right around here when it pulled. See, it went all the way up to 75. It pulled back here to 50. That was where we thought it was very good. At that point, it was paying 4% dividend, and you were buying it at a 35% discount. It ran all the way up to 85. Do you understand why we don't want anything to do with it here? Because the moving averages are way down here. And not only did it come down here, but it blew past it down to this support area down here. So again, we are not keen on this just yet, other than we could get a bounce off of the 40, these highs here, which is what? These highs came in at around 42. What's the low been? The low has been 42. So there's a reason why it's holding this area. If next month in September, we do not take out that low and it starts to go higher, we would be more interested in it. And then we would look at the shorter term graph to get our indicators. So right now, if it can start getting above 46, 48, and there is a gap there, and there's a gap there, it could see some type of a rally. Okay, but right now it is premature because right now everyone's talking about cutting the inflation rate and the Fed, hiking and sticking with this thing. And that's obviously been beating up the gold. I'll show you a time frame if you go back. And I'll give you the price of gold right now, because we've been pretty accurate on this as well. Basically accurate by saying stay away from it until it gets above certain levels. That's how you can, that's an accurate, doing nothing is also a trade, right? So, or it's a decision, let's call it a decision. Buy, hold, or, stay away. Okay, so we've been from the stay away thing on the gold because we do not like the fact that it is under the averages here. Okay, so we'd like it above 1763, then we would be more keen on it. We'd love to see it get above 1825, 1850, then we would be very more keen on it. That would also take this RSI back above 50. So again, if they are going to not do what they say, which is hike until inflation's at 2%, and if they pause for an extended period of time at a relatively low rate, like 3.5%, then, and again, look at history. Don't look at the last 10 years where they were printing $9 trillion. That game is done. Okay, they printed $9 trillion. They moved the balance sheet to $9 trillion. How do you think interest rates got to zero almost? That's the way it happened. How do you think these asset prices went through the roof? Because valuations went through the roof, because interest rates were at a ridiculously low price and they printed a ridiculous amount of money. That horse is out of the barn and gone. So what do we have to look at here? We have to look at a situation where, they're going to have to get a little tighter with money. They're going to have to slow down the money supply, which they've already did. Okay. But that may not be enough, and if in fact, people get concerned about the currency, because once they pause, maybe that dollar rolls over. I'll show you that in a minute. And if that happens, maybe that's good for the gold here. But right now you've got to either be out or monitoring it. This is a place where, it could easily drop down towards 1400 if it starts breaking. Look at what happened between 2013 and 2019. This thing came down and basically it stayed in a down deal, had a pop, stayed basically between 1100 and 1300, for years. So again, who knows what might happen, but, maybe it'll be between 1700 and 1400 for years. Okay, it's possible. So the bottom line is we've stayed away from it. Again, this pop did not mean much to us. It got too far away, it's a double top. And so now that it's under these numbers here, we're not that keen on it, but we monitor it all the time. And if the prices change, we certainly will change as well. So again, that's pretty much it. Now let's look at that dollar index so you get an idea of what I'm talking about here. Because this dollar is definitely murdering emerging markets and it's hurting all the companies. 50% of revenues from the S&P comes from overseas. Well, again, with the strong dollar and slowing economies over there, that's not really helping. So let me just put the dollar index up here to close out and give you an idea of what that means. Okay, I'll show you what I've seen here, and then you tell me what you think. Okay, in 2003, the dollar index had a rally. In 2008, it had a rally of 70 to about 90. That's a 20-point rally, right? Then it had a rally in 2015 from 80 to about 100, right? And now it just had a rally from 90 to 110. So if you want to know why we are monitoring the dollar peaking and rolling over, is because A, it has 20-point runs and then runs out of steam. We have some history of that we can see right here. 70 to 90 ran out of steam. 74 to 90 ran out of steam. Okay, here we go. 80 ballpark on the breakout to about 100, and it popped to 104 for a little bit, but then it ran out of steam. And sometimes things make a little bit of a new high and then it tanks. And then here we've come from here. So look how far away it is from the averages. Remember we talked about reversion to the mean. That makes us suspicious. So now we'll look at the 1 year graph to see where we're going to signal. And again, what we've been saying is if it gets under 105, okay, and starts trading under there, and certainly under 107 would be your first tip, and 105 would be a confirmation that this baby is turning over possibly. And that would take your RSI under 50. Okay. All right, guys, that's basically how I'm seeing what's going on right now in a whole bunch of different sectors. Now, I'm just going to explain before we sign off what we can do for you. The Option Professor, we've been in this thing for many decades. Okay, so we have a certain amount of experience and knowledge, and we are trying to share it with you. Our opinions and our observations. That's what we're doing. We're not giving out advice because, again, you are supposed to get your advice from your brokerage firm and your broker who knows you, who knows your circumstances, and who knows all about you. They are supposed to be in a position to give you advice. We are not. So we are not giving advice, but we are giving information and our views and our opinions as part of research, right? Okay, so what do we have? We have PDF reports we put together. One is on what? How to hedge against market declines and how to hedge against upside surprises. We think it's very helpful. Second thing is we have how to do the covered call writing to protect your cost basis and to create income into your account. And there's a lot of different ways to do covered writing. We have our own view. We have a PDF report on that. We also have a PDF report on our best technical indicators, the indicators we use to try to create an opinion on market direction. And we include that. So you get 3 PDF reports and you get a 1-hour session with the Option Professor. And we can go over all the questions you have on option trading, on the markets, and you get our opinion and you get our observation. Again, we believe we are an informed source, so we think some of our information can be helpful. Now, we get all of those things sent out in a one-time package. So if you have an interest in that, you go to optionprofessor.com, OPTION, professor, PROFESSOR. So it's singular. Some guy put an options professor out there after we had ours, obviously trying to play some kind of a game, maybe, who knows. Bottom line is OPTION, professor at .com. And then you put your email and your phone contact. We'll get a hold of you. We'll get this stuff out to you, and we can set up your time to have our session where we can talk and hopefully help you with your questions. If you're new to the markets and you're new to options, you obviously need more education, and one-on-one education with somebody with over 35 years experience should be a little bit helpful. Number 2, because we go over the uses and risks of these option tactics you've heard so much about, or maybe you've tried and failed at. Secondly, so if you're new, very helpful. Then if you're experienced, oh, I've been in the markets, oh, I know this and I know that, or I subscribe to this guy's letter for $5,000, or I do my own trading. Listen, if you're experienced, we call them salty dogs, you probably could use an independent eyeball on some of the things you're doing and an independent eyeball on some of the things that you get in these newsletters that are not working or haven't worked. So obviously getting a fresh look at what you're doing, if you're experienced, is probably not a terrible idea either. So again, whether you're new or experienced, I think there's some value we can add. Again, you can make your own decision, but to start out, just go to the website, put in your information. We'll talk. If it's not for you, God bless you. If it is for you, hopefully it'll be helpful. Okay. OPTION, professor, PROFESSOR.com. You put in your email, you put in your contact phone, we'll speak and we'll see what we can do for you. Obviously, in our belief, we believe we can help people. That's why we try to do this as well. Okay, so do that, get all the details you have. Obviously, I tried to do my best to give you a flavor on some of the ways we look at things and some of the things we've talked about. Obviously, our last call on the S&P having a lot of trouble at 4350 was a very, very good, helpful bit of information for people. And we hope to do more of that in the future. Okay. Again, this is the Option Professor. Good luck and good trading. Go to the website, optionprofessor.com, put your information in, and then we'll talk. Okay. Have a great day, everybody, and a great holiday weekend. It's Labor Day. Let's go have some fun.